Welcome to the Rose Show podcast. Thank you so much for joining us today. I have the honor of being here with Helene Meisler, a world-renowned market technician and equity trader. She is one of the pioneers in the financial industry for over 40 years. You can find her tweeting on Twitter or writing at thestreet.com. So how you doing today, Helene?
Good morning. Thanks for having me.
Absolutely. We're so honored to have you here today. So we want to know more about you and your 40 plus years in the market. Tell us what drew you to the markets.
Oh, probably it was about the only place that was hiring in 1982. And so I took a job because this headhunter I was working with said, "Oh, I think you'd be good in the markets." And so I went for an interview, several interviews, and I got a job. So I took it. That's the honest answer.
Love the honesty and the simplicity in that. And that is definitely a motivator. Well, I guess he was right that you'd be great in the markets. So you learned from Justin Mamis the art of technical analysis. So tell us, how did you start? What was your first job in trading? And then how did you get to learning from Justin the art of technical analysis?
Well, my first job was as a lowly assistant to the partner in charge of institutional sales at Cowan and Company. And I was literally, I don't know that there could have been anyone lower on the totem pole than me. If there was, it wasn't obvious. And I had to do all the crap work. And but it was the beginning of the bull market in 1982. We'd basically been in a bear market for 10 years. Nobody had been coming to work on Wall Street for a decade. They were just happy to have somebody who was willing to learn and somebody who, could learn. And so I was like a bit of a sponge, and I just absorbed it all. And I did everything that the partner asked me to do in an effort to learn. And that meant, a lot of crap and some good stuff. And one of the things that he had me doing was I used to have to make these, oh my God, they were the most boring calls. But I learned back then, we're going back over 40 years. Back then, the clients were mostly major big banks, like the trust fund of a major big bank, the trust area of a major bank. And the portfolio manager was lower on the rung than the analyst. And the analyst kept track of what everybody's earnings estimates on the street were, like all the sell side earnings estimates were. And so we were at Cowan, we had the top technology analysts in almost every area.
Wow. Most
firms back then only had a technology analyst. Cowan, we had a microcomputer analyst, a mini computer analyst, a semiconductor analyst, a PC analyst. And you have to remember, this is before all those stocks we know today even went public. And so if you wanted to be in technology stocks, you basically had to do business with Cowan. Anyway, one of my jobs was that if one of our analysts, let's say our IBM analyst, tweaked his IBM earnings estimates by a nickel due to a higher tax rate, I had to sit down and make calls to all those analysts at all those banks. Hi, it's Helene Meisler from Cowan. We've tweaked our earnings estimate. Here's the new estimates. It's only due to a higher tax rate. We're still recommending the stock, something like that. But, you make enough of those calls and you learn the stories behind them. You learn what moves stocks. You learn what people care about when it comes to stocks. And you can see how the stocks react. And so that's kind of my first couple of years. That's what I was doing. I mean, obviously, I graduated to a bit more interesting calls, but that's kind of how I started. And it was, for me, it was exciting because for me, I didn't know anything about how markets work. So I thought it was great. until I didn't, until I thought, oh God, if I have to make another one of these Smith-Klein-Beckman calls, I'm going to die. And for those who don't know, Smith-Klein-Beckman was a big drug stock back then. And I think they ultimately got bought out by Upjohn, who got bought out by Bristol Myers, I think. Anyway, we covered drugs, we covered biotech, we covered a lot of mostly, technology type stuff. Like we didn't have an oil analyst, we didn't have an energy analyst, we didn't have anybody who covered the steel business. We didn't have any of those cyclical stocks. We had, the highfalutin technology, the high growth technology stocks. Anyway, then so that was I went to work in December 82, and in 84, Cowan hired Justin Mamus. I think it was 84, something around there. And I used to sit in the morning meetings and I used to think, oh God, he's so interesting. Listen to the way he talks about markets. And I love the way he, analyzes everything. And I didn't know how to read a chart. I didn't know. Some people might say I still didn't know the fundamental side either, but I was learning. And anyway, I asked if I could work with Justin. And, I think part of it was I was in the right place at the right time. Cowan was terrific to me. The people I worked with were fabulous. And so they agreed. And so I moved from maybe not the lowest rung on the ladder. I maybe went up a half a rung to being able to work with Justin. And they gave me also the hedge fund business was tiny back then. There were, you were just starting to get people opening up their own hedge funds, maybe with, $10 million was a lot. And so they allowed me to cover a couple of $5 or $10 million hedge funds on my own, which was a big deal. And anyway, so it was, I learned a lot. And part of the fit of the clients I covered was people who wanted to learn more about technical analysis. Because you also need to remember back then, the fax machine was new technology. We didn't have email. We didn't, and so we didn't have, you couldn't pull up a chart on your screen just because you wanted to. You had to have paper charts because that was all there was. And so most people didn't know how to read a chart. They joked much the same way they joke today. And so it was, in many respects, they knew technical analysis, but they didn't apply it. Most people didn't apply it. And they certainly didn't even know most people didn't know how to read a chart or even, I would say even people today who don't know how to read a chart probably take a look at the chart anyway, even if they're not chart people. They sort of will look and, oh, that's support, that's resistance. Anybody kind of see that. And, but again, back then you didn't have that. So the clients that they gave me were people who wanted to learn more about charts. So that was helpful to me because I had to learn more in order to guide them. And that was it. And so I don't know if you can see it, but there's one of my paper charts.
Love it.
On the wall behind me. And that's what I had to do every night was put a pencil to the paper and high, low, close, and volume. And that's what I did. And I have a big pile of charts.
Love it.
And to this day, I still do it.
I saw you tweeting some hand-drawn charts.
Yes. I tried to give it up in 1996. And when my husband and I moved to Asia, but it took about a month before I felt like I didn't really know what was going on in the market. So I opted to go back and do it. And I had to fill in that whole month on all my charts. But so that's it. That's how I got involved. And then in the late 80s, I got a call from Goldman Sachs. They had never had, again, this is, you have to understand what the world is like. And they had never had a technical analyst before. And would I be interested in coming to talk to them? So of course I went and I got the job. There's a lot of funny stories about that. But and again, I think maybe by then, by the late 80s, you had a couple of chart services where you could pull up a rudimentary chart on your screen. And even like a Bloomberg machine was so new then, because Bloomberg had mostly started out as a bond service, I guess. And so, you know, that was my first introduction to a Bloomberg machine when I went to Goldman. And I didn't know what any of those, you know, God, they had all these symbols you had to plug in just to get something on the screen. But it was the first time I'd ever been able to get a moving average on a screen or anything like that. So it was pretty unique and it was kind of neat.
That is awesome. I know you're the first ever technical analyst at Goldman Sachs. And, you know, it's that drive to learn. You have that growth mindset and you were curious and you just kept going for it. And it's through hard work that you really learn. And then you're actually hand drawing. It's like you're feeling the movement of these stocks. And it's just totally different. I respect that so much. I'm a blend of both. I mean, I grew up in the 80s, so I know that time period very well. And, you know, it's vastly different from now. How was it as a woman in finance and being in this field? Because I know, I mean, it was very challenging and I experienced some of that, you know, starting out myself, but were you one of the few women in the field?
Yes. I will say at Cowan, when I went there, they had one salesperson in the New York office. They had one salesperson who was a woman, and I think we had a woman salesperson out of San Francisco, and that was 1982. So, and they'd both been around for, you know, since the 70s. So it wasn't like they were young. They were probably both, I don't know, I guess 35 or 40 years old already. So they'd clearly been in the markets for a long time. And we then hired several women as you know, in the time that I was there. So I don't know. I mean, this is hard to explain, but I have rarely, if ever, felt any sort of discrimination. And I don't know, maybe women were treated differently and I just was so oblivious I didn't even notice. Probably, I'm sure, I am certain I probably got paid less, but you know, I don't know if I felt like I was getting paid fairly. It didn't matter to me. And then I went to work at Goldman, and I want to say there were about 3 professional women on the trading floor. If I'm wrong, maybe there were 4 out of maybe a few hundred in equities. So that would include the international people and the sales people and the traders, and you know, and even so, I don't know, it didn't feel, I never felt like nobody cared what I had to say because I was a woman. And one of the traders, he was a futures trader, an S&P futures trader at Goldman, used to come over every morning and ask me, you know, what the indicators say, and, you know, what's the outlook for the day, and all the rest of that sort of stuff. And he once said to me, you know, here at Goldman, nobody really cares if you're a man or a woman, if you're black or white or green or yellow. We only care, can you make me money? And I thought about that, and I think that maybe that was my experience, was that if I was making people money, I don't think they cared. Again, maybe I was oblivious. I don't know.
That's
But,
awesome. That's good to hear. An insider point of view. You experienced it. You were there. That's great to hear. I want to know the differences, and then there's vast differences. However, as things change, they seem to stay the same, and simplicity is key. But comparing the trading in the 80s to now, what are, to you, do you miss some elements of that simplicity and lack of information overload? Do you think too much is too much? And I know you still hand draw your charts, which I love. I admire that so much. And what do you like and dislike? What do you miss, if anything?
All right. Well, let me go back to I didn't have a lot of money, obviously, when I first joined Cowan in 1982, and then, I sort of gradually. But at Cowan and at Goldman, we had what was called a 30-day rule. As employees, you couldn't buy a stock and just trade it. You had to hold it for 30 days before you could sell it. And then if I remember the rule correctly, if you then sold it, you couldn't go back into the same stock for another 30 days or something like that. So I had to learn to go from talking to hedge funds who were flipping stocks at times and working with that. If I was going to be trading my own account, I couldn't look at a chart and say, oh God, okay, I think this stock could pop in 2 days. Because if it pops in 2 days and it doesn't continue, I'm still stuck holding it 30 days later. So I think that sort of informed a lot of my style, which is to find stocks that are down and out, that take a while to develop, that generally won't pop for a few weeks. Because I had to learn to time it better.
Yes.
So that when I got the move I was looking for, I could sell it. And so, I don't know if anybody has a 30-day rule now, but the other half of it was you also paid so much more for commissions. And so you didn't trade for $1 because it cost you so much to get in and out. You had to look for something more. And I think nowadays, a lot of us will trade for a much smaller amount if we're just trading. Because obviously it doesn't cost so much to get in and out. Anyway, so in that respect, I've had to adapt from not having the 30-day rule. And I'm not very good at that, I will say, because I spent the formative years trying to adjust to that. And so, once you've developed that style, it becomes quite hard to change it, really. I mean, I'm an old dog. It's hard to teach new tricks. And it just feels better to me. And maybe that's part of the pencil thing. I also don't use a lot of those fancy indicators that like RSI and I don't even know, stochastics and MACD and all that. I don't do any of that because I just put a pencil to the paper. So to me, it's how the pencil feels. And it's not something that you can really describe to somebody. It's like, oh yeah, buy this because the pencil felt good. I mean, it sounds ridiculous.
No, it makes sense to me. Absolutely. It's expertise-based, intuitive decision-making. It's from years and years of you experience that ebb and flow like through your hand. It's like you embody that movement of that stock and you can feel it as you're actually like internalizing it. And it's just amazing. And it becomes part of intuition that you can't explain it. And it's just a feeling that you get and through that handwritten chart. I mean, it's just, I love that. I just love it. You need to like put them on a wall. Like, I love how you did that on the wall, but these are like classic. And it's the more things change, the more they stay the same. And it's the things that work. The market, it's changed significantly in my opinion, but it's still that simplicity that's key. And, just love that.
It's, I also, the other thing that I have learned, and I don't know if it's from trading or from posting the charts by hand or maybe a little bit of both. There are certain stocks that have to go on my restricted list because no matter what I do, it doesn't work. I can look at a chart and I can think, yes, and it's trading just like this stock, and somehow or another, it doesn't trade just like that stock, because every time I buy it, I lose money. Or every time I short it, I lose money. And so, I don't know if that's partly, again, just experience or putting the pencil to the paper or what, but you also learn, you learn what stocks you trade well and what stocks you really trade so poorly that have to go on your restricted list.
That knowing yourself, and trading is it gives you immediate feedback, but it's about learning about yourself and what works for you. And that's key. Absolutely. I agree. I'm the same way. I have many restricted ones as well that just don't work for me. And even though I want them to, but
I know. And the worst part is you keep going back to the well because come on, it has to work.
It has to. It's work. It's statistically, it hasn't worked this many times. It just has to work this time, right? But no, it doesn't work that way. So we got to be disciplined with that. It's controlling that, impulsiveness and reaction from the emotion. And that's key. And I'm sure you've learned that over the years, and you know yourself. And how do you have that mindset to just keep coming back? I mean, look, even everyone, you don't win them all. And so it's accepting those losses and being able to move forward.
When I went to manage money at Cargill, I went to Cargill to their to their financial markets division to manage equity money for them. Justin said to me, "I hope your first 5 trades lose money."
Yeah.
Hey, that's not fair. And he said, because you're going to learn a lot more about managing money if you lose than if you win. And he was 100% correct, because we all, I think, at least I know for me, I learn a lot more when I'm wrong.
Absolutely.
Than when I'm right. I like to focus on when I'm right, but that wrong hurts so much worse than the right. Feels good, I think, is what I would say. So, you go back and you try and figure out, what did I do wrong? And sometimes I can't figure out what I did wrong because I look at it and I say, I would do the same thing again. And sometimes you just have to chalk it up to markets. Because as I'm fond of saying, they wouldn't call it trading, they'd call it winning if you got them right every time.
Absolutely. Well said. And Justin was completely correct. That I've read, and I agree completely, that there's nothing worse than having easy wins. And, it's, and you have a great profile. Not only do I love nothing like price to change sentiment, but I love what you have, how bull markets make people look like geniuses. And it's, the 2020 market, which is just a recent example. And I've traded on and off since pre-2000 myself. So I've experienced some bear market cycles, not like you have, but, when we have these easy wins, and it's like we just build bad habits. And we don't learn. And it's through the losses that we really learn. We need that pain to just know it's not easy. And, we need to follow our rules. Do you have trading rules that you have set out that you follow?
It's interesting. Do I have rules? Yes. Do I use stops? Sometimes.
Sometimes, yeah.
Because there are some times where I say to myself, I just know I'm going to be right. I'm one swing too early, or I'm just a week or two too early, or I can just absolutely see it playing out. I mean, I'll give you a good example. In the middle of May this year, as technology stocks were going into that big swoon,
Mm-hmm.
I kept staring at energy and banks. And I kept thinking, they look so bad
Mm-hmm.
that I just know people are going to come for them by the time June rolls around. And I wish I could give you a list of reasons why. Maybe it was the pencil feel, maybe it was, I don't know. But I mean, if we want, we can take a look at a chart of XLE.
Absolutely. I'd love to.
Do you want to do that?
We can do that now as you're talking through it. And just, if you could, we want to go into your mind. And that's the purpose of this, is just to understand your processes and how you see this. And hopefully we can learn by watching you in action and how you view this.
Well, all right. I don't know that we can learn a lot, but here's the chart of XLE. And right around that mid-May area, you can see it made a low around 77.
Yes.
And then had a little rally just over 80, and it came down and it broke the line.
Mm-hmm.
I am ridiculous in that I like when we don't hold a line.
Mm-hmm.
I think breaking a line is more often than not bullish.
Mm.
But not all the time. But in this particular case, sentiment had gotten so bearish.
Mm-hmm.
I mean, everybody had been talking $200 oil. Yeah, well, they were talking $200 oil
Yes.
way back here when, energy was so high, and that was a good time to be selling it. But I tell you, I noticed, I guess it's just about a week ago, all these people have been looking for $200 oil were now saying, no, 50 is coming, and 50 is coming, and 50 is coming. And I'm thinking, and I had been looking for 75, 77 on XLE for a month. And so I love that we broke that line, got right down to that price level that I'd been staring at, and everybody had gotten bearish. So it's still an ugly chart. I mean,
Yes.
There's so much resistance overhead, but for a trade, it's been terrific.
Mm-hmm.
And I'm not sure that the trade is done yet. I think obviously, all those $50 oil people yesterday started, well, energy's okay again. And but so this is also something that's very difficult to explain, because how can I tell you we broke the line and it's bullish? But to me it was.
According to rules nowadays, you don't want to buy that break. That's a scary break. I mean, there's so many different theories out there, but you can just feel, energy, and you've watched it for some time, but it's also that sentiment, it's that psychology. I remember I actually spoke about it on the last podcast I did with a commodities trader, and I was like, remember when they were saying it was going to be $200 oil? And it's like everyone it's nothing like price to change sentiment, exactly as you say, because when it was going up, everyone thought it's only going to go higher. So it's the reverse here, that now these people are saying it's going to go to 50, that you just know that it's that same mentality reversed. And it's like, probably not going to go to 50, just like it didn't go to 200. So maybe it goes back up now. Once it's a buyers and sellers market. So once the selling is done, what's left? I mean,
it's I think for so many years, because we had zero interest rates.
Yes.
We didn't really have a two-sided market. You had, buy the dip, buy the dip, buy the dip, buy the dip. You may have had certain groups didn't work well, but you had buy the dip, buy the dip, buy the dip, buy the dip. And I think with higher interest rates, you have a market that has two sides. And it's a better, to me, it's a better trading market.
Yes.
Is it easier? Sometimes yes, sometimes no. But anyway, to go back to the XLE chart, I want to just point out, you might notice how thick my lines are. You asked about rules. I get a lot of people mostly on Twitter, because people who read my column know why I have thick lines. Why lines so thick? Well, I'm going to tell you something that the charts I do are from John McGee, Edwards and McGee, which to me is the Bible of technical analysis book. And John McGee had a rule. And the rule was that if you break a line or you break support or resistance, you need to do it by 3%.
Mm-hmm.
Because otherwise it is often false. Now, I haven't done the math here, okay, to know if that was a 3% break. But the first thing I do is I start with thick lines.
Mm-hmm.
Because if I break a thick line and I can see it with my bad eyes, then I know it's a break.
Yes.
Okay. And my second rule is if I'm buying a break because I think it's going to be a false break, it has got to recapture that line fast. So if I buy the break and then it sort of meanders around and doesn't really rebound quickly, I know I'm wrong. But if I can recapture that line quickly, I know that that was a shakeout.
Mm-hmm.
And that to me is one of sort of a Helene rule, if you will.
Mm-hmm.
So
it's like a little margin of error there. You make it a little thicker so you have that little room there, that 3%-ish.
Right, exactly. Again, I don't know. I didn't even do the math to know if it was 3% or not. Maybe it wasn't. But, you know, I knew I'd been looking for 75, 77.
Mm-hmm.
It got into that zone and the sentiment was so poor.
Mm-hmm.
So I took a chance that the break was going to be a false one.
Yes.
And I'm going to keep my loss to a minimum if it isn't, because again, if within 2 days it can't get back over that line, I'm wrong.
Mm-hmm.
So
very nice. I like that, how you played that with the psychology.
I got lucky. I got lucky because let me tell you, let me go back. I started warming up in mid-May to energy and banks. And I knew I was going to have to suffer for a little while because I didn't think the market in general was going to make a low until late May. And what we got there was literally, I mean, I was so frustrated because I kept thinking, oh, come on, they've got to get better. The down and now, you know, all right, to go back to sentiment, I've been writing a lot about how I've thought up until recently that we have two different sentiments in the market. And we have the exuberance in technology stocks, where people think the sky's the limit.
Yes.
And then we had everything else, not just banks and energy, but you had industrials and, you know, commodity stocks. And to me, you were literally in 2021, you had all those the non-technology stocks were also down and out, but no one cared. Sentiment stayed buoyed. It was people were still bullish. But you didn't have that this time. This time, everybody saw the divergence. Everybody could see it, and it kept people bearish and they were especially bearish on the down and out names. So my thinking was the bullishness of technology is up here, the bearishness on everything else is down here, and I didn't think the technology stocks had to come down, which is common thinking, and meet the rest of the stocks. I thought these stocks have to come up, and that if these stocks come up, the bullishness will start to converge, or at least the gap will close. And I think that's where we're at, because I'll show you, you can see.
Now, do you look at the macro? You Okay, you traded in the early 80s, which was stagflationary conditions, which people are saying we are sort of in right now. We're getting there. And now we have risk-free rates in the 5.5, almost 5.5% range, higher than the earnings yield of the NASDAQ and SPX. Are we in a different environment? And do you think that we could be due lower? Do you look at that? Do you think of it in that way?
I don't think of it in that way, but it must be a year and a half or 2 years, I can't really remember, coming up maybe on 2 years, that I keep thinking we're in that period of similar, not exactly, but
yes,
similar to the late 70s.
Yes, similar. That's
where we were in a 20 or 25% trading range in the market. And sometimes we peek our heads up over it and come right back down. Sometimes we break out of the bottom, come right back up. And, people think the 1974 low, greatest buying opportunity in the world. But you know what? You bought and then you went sideways until 1983. So, I sort of think people forget that you had, almost 7 or 8 years of ups and downs and ups and downs. And I don't understand why we couldn't do that now.
That's what I'm thinking, actually.
Even if it's a quote unquote new bull market, new bear market. I mean,
yeah, there's an obsession with that, right? Like there's an obsession. Last year, I love your article. You are an excellent writer. Besides being a technical analyst, you're an excellent writer, Helene. And you talked about how everyone was obsessed last year with the VIX going to 40. And now the new obsession is this a new bull market?
Like, who cares? Are the majority of stocks going up? Yes. Then we're buying. Are the majority going down? No, we're selling.
Yes. It's better to be long right now than it is to be short.
And to tell you what, going back to the 80s and even in the 90s, I don't ever remember anybody nobody was so busy labeling markets. I just don't remember that. Maybe I was asleep. I don't know. All right, but let me show you. So to get back to my premise that, technology bulls, everything else bears. And my view is, that these will rise up. You can see that this week has turned a lot of people bullish. This is the American Association of Individual Investors, which I'll preface by saying I think is a crap survey, but be that as it may, look at the rise in bulls this week. And that is not due to technology, because technology hasn't done anything since Memorial Day. Because so if it was technology, you would have seen the move last week. And this is everything else, the banks, the energies, the industrials, the commodities rising up. And so you can see we've got the most bulls we've had since the fall of 2021. We also have the fewest bears since the fall of 2021. So my theory is playing out in that, as the down and out stuff rallies, people get more bullish. And if you take a look at what happened in the market yesterday, technology stocks got smashed. And people didn't seem very concerned. Oh, it's okay. They're just resting. They've had a big run. And, and so that's, again, I think that's why sentiment wise, you're getting the bears converting to bulls, but you're not getting your technology bulls concerned. And eventually I think we're going to rise up and everybody's going to be bullish all at the same time. Now, and that's probably when I'll turn bearish.
Yes, right. And there's like the extreme greed and fear, there's all that indicator, and they're saying we're in a greedy market right now. And do you think that it's getting to be overbought at this point, or do you think it's just the breadth improving and much needed to have it across a love fest across the board?
I think we're not quite fully overbought. I think on an intermediate term basis, I think we're getting there. I I think we got a little carried away in the last few days. Like if you take a look at, if I can find it, when it comes to the everything else,
the IWM.
I use the IWM, and you can see you got right up to a big resistance area. So if you just fell in love with IWM yesterday, take a breather, guys.
Yeah.
I mean, you're a little late to the party. We're up 8% in the month. So, these stocks should now have a rest, and maybe they roll back into technology a little bit, but you've changed the sentiment. So, but in terms of overbought or oversold, I have an intermediate term indicator I like. I call it the volume indicator. And you can see when it gets down here, like in that 45% range, you start to see that we get oversold. I mean, you can almost see how the low a week and a half ago coordinated with that coming up out of that range in the S&P. The S&P is the red line. And it will get overbought when it gets to the mid to upper 50s. It's a very narrow range. And the oddity is that even in the worst bear markets, like take October of 08, the worst it ever got to was like 38%. And so if you get down to 42%, that's pretty oversold. And the best we ever get to is the upper 50s. Maybe we've tagged 60% once or twice. And we're at 50% now. So I think that's going to get overbought in the next week or two. And if that gets overbought in the next week or two, and let's just say that gets overbought in the next week or two, I've been monitoring. I like the number of stocks making new highs. It's been improving. As you can see, obviously people get more bullish when there are more new highs. What a shock.
Yes.
But we've got that peak reading at 200 new highs from February. If over the course of the next couple of weeks, people get more bullish, the number of stocks making new highs cannot get over 200. And that indicator, that volume indicator, starts to creep up and is, 55% or something like that, I'll probably turn bearish. So I would say those are probably the things I'm watching most.
That's what you're watching. So regarding stocks that you trade, or do you trade in sectors and XLE, for example? Are there specific indicators that you watch closely, like moving averages, Fibonacci levels? Do you utilize any of those other indicators?
I use a 10-day moving average of net breadth to calculate an overbought, oversold in the market. So like this is the blue line is my overbought and oversold. And you can see it tends to trade fairly well with the S&P. It trades better actually with the Russell. But you can see, I mean, the whole time we were sort of churning back and forth under 4,200, the oscillator was sort of oversold-ish. And now you can see it's starting to move up. Again, I would expect this to get overbought. It's a short-term overbought, oversold. I would expect it to get overbought by next week. Obviously, just in time for the Fed.
CPI and the Fed.
CPI, the Fed, maybe its expiration. Is it?
Yeah, it's a quad witching.
Quad witch. So, you can see a reason why you start to think we're going to get a volatility move maybe next week.
It's interesting how they all align together.
I know. As I always say, I don't write the rules.
Now, do you use fundamentals, and you also keep an eye on the macro? Or are you mostly focused on the technicals? They seem to align anyways, but what is your focus and when you're looking at the markets and when you're identifying trades and setups?
Well, I definitely read the news. And that's probably about the extent of my fundamental thinking. Like I'll tell you, I turned bullish on home builders. I don't remember. They were
running like crazy nails.
They were, I want to say I was bullish on them. I don't remember when, but in September, if you go back and you take a look at my tweets, you'll see everybody was hysterical about the home builders. Interest rates are too high. Nobody was ever going to buy another house. Never. Interest rates were too high. That was it. Never would a house be sold. Well, of course, if you know from the 80s, plenty of houses sold at much higher interest rates. So you think to yourself, my God, these people, I don't know what they're smoking.
I know.
And so in that respect, I took a contrarian view, and I took a look, and I thought the home builders are back at support. They're not going anywhere. They're, for all the hysteria, they're not going down anymore. And oh, by the way, I think interest rates are peaking here anyway. So in that respect, I sort of took, you might call it fundamentals, but I would just call it news and sentiment and the chart, and thought, well, home builders look like a buy to me.
Absolutely. It's that experience, and from experience what happened in the past, but it just doesn't make sense at some point. Yeah, it's a sentiment when they're just so bearish, and then they're like, it's the end of the world. I mean, no one's buying a house again. I mean, that doesn't make any sense. And then you go in and you see the support. Beautiful. I love that.
And now, of course, let me tell you, find me a homie, as I call him, homie. Find me a homie bear. Now everybody has the same story. Interest rates don't matter. There's a housing shortage. Yeah. I'm out of the home builders. They may go to the sky. They're not for me here.
So, Helene, tell us, what are you eyeing right now? What is not making sense to you, and what are you being a contrarian on right now for the future?
Like I said, it's difficult because I feel like we're kind of in the middle of a move here. So when we're in late May or mid-May, I'm harping away about the banks and energy, and this is where I'm focused, but I can't buy them now because they've moved up so much. And I don't really have a lot that's so down and out now. I'm sort of a little warming up a little bit to some biotechs. I may start to like the drugs again soon, which I haven't liked it in a while. And I may start to like some of the staples again.
Yeah, that has come down quite a bit. I was looking at that chart, not too great over there.
Right, they haven't come down quite enough. There's not enough there for me to feel like, I'm interested. I would like a little more hate towards staples. Would make me feel good about buying them.
Yeah, that XLP chart.
Especially if they break that line.
Absolutely. And the XLV, the healthcare I was looking at, the utilities. Do you do?
I like utilities. I like utilities. Yes. I warmed up to them about a week ago. Exactly. So I still like them.
Yeah, and the industrials have been doing very well above their moving averages. You got the tech, discretionary.
Those retailers are pretty dog. They've had a rally this week, but they've been
they rallied, but
doggy.
Yeah, the staples, interesting. It seems that we were value last year, and I sometimes look at that SPYV versus the SPYG. And I saw that a lot of value last year. Now everything's going to growth. Do you think we're going to rotate back to more value, and fundamentals matter, and everyone wants that cash flow and those dividend stocks?
Oh, I think that may be getting ahead of yourself in terms of how people are thinking. I think if we start to get any sort of a slowdown, and bonds start to rally, which I think they will again, even though, most people are in the higher for longer camp on bonds. I just think you'd start to get a rotation back into staples, which people have now spit out in the last month. But I'm probably more focused right now on what's going to happen between now and the end of June, and how bullish people are going to get, and how those indicators are how those indicators are going to get overbought, and if the buying we've seen in the last week in the down and outs is going to continue.
Yeah, well, let's talk about AI. AI was a big one to add fuel more to the technology, I believe. And so that my next question is, what's your time frame then? You're a swing trader. So I know you did that 30 days in the past. Is that still your ideal window? Is at least 30 to 60 days? What type of time frames do you like to trade?
Again, I just go by what the indicators say, and best I can tell right now, I mean, it's still a few weeks away, but best I can tell by now is I think this run that we're on stalls out in late June. And then if that stalls out and I'm right, there's a big and I'm right part too, because I could be wrong. And which we all know happens a lot. And if I'm right and we start to get a swoon in July, you know, maybe we don't get a swoon, maybe we just sort of run out of steam and don't really do anything. Maybe the market just, you know, chops about. We'll have to wait and see. Oftentimes after the kind of run that you've had, you would do a lot more chopping about than you would turning and reversing and heading down. So, you know, then I would probably just be looking for chart setups in stuff that has scooped under and starts to feel better. But that's, you know, I've got to wait and see if what I'm expecting in late June shows up. And then if that turns out to be correct for something, a move down sometime this summer.
Got it. So overall, bird's eye view over this year, you would say we could very well be in a sideways market with these nice runs, a very tradable market, but we could anticipate some, you know, staying in this large range that we're in.
I mean, we could go to 44 or 4,500 on the S&P, and I would still probably think what I'm thinking. Because I just have that 1970s chart in my head. And if you take a look at it, you will see there were times it got out of the range. And you know, if you go back and you look at the investors' intelligence, bulls and bears, you can see everyone got too bullish, and then boom, you came right back into the range. And then at some point you fell out of the bottom, and everybody got bearish. And then that to me is just likely, as long as interest rates are not at zero, that is the most likely scenario.
Yes. Well said. I like that, how you have two sides to the market, unlike this free money and negative rates that we've had, zero rates for quite a bit of time now. And so it's a little bit different. We shouldn't fall for the recency bias and look in the bigger picture. Now, referencing the 70s and 80s, what are your thoughts on commodities? Do you think they're going to come back in fashion? And you think gold is in a cautionary area right now? It didn't, that 2100 resistance, I think it hit it 3 times. And do you think gold goes to 2100 this year? Or do you think this is the year, it seems, for gold and silver with this stagflationary environment? What do you think over there?
Right now, I think gold probably in the next, call it the next week or so, probably there's a trade to the upside, but I'm not sure it's more than I don't think it's enough to break out. I think it's just a trade. I think the precious metals in general are probably setting up that way for a trade to the upside. But nothing that's going to get me terribly excited.
Silver ETF.
Yeah, silver. You know what? I haven't looked at the silver ETF, but I've warmed up to Pan American Silver.
Oh yeah, PAAS is it?
Correct.
I like that one.
So I warmed up to that because, when the stock got to, I don't remember the price, I want to say it was $18 or something like that. Everybody got excited. It was breaking out. And, now here it is back at 15 or 14. So in the 14 or 15 area, I kind of like it for another trade back up. But do I think it's going to be the next NVIDIA?
No. No.
I think the dollar is in a trading range. I think a lot of what we've got, I think bonds are in a trading range. I think everything is in these big, giant trading ranges, not tight ones, big ones.
Yeah, we got the dollar 104. I think we have it's in 100 to 105 range.
I think the dollar could easily go to 106, get everybody excited, and then come right back down.
Yep. Break like you have your line. Break that upper side that everyone's talking about in the 105s, get everyone excited, and then come back down. I like that.
I mean, people will often ask me, well, what level? I'm like, I don't know. What's the sentiment going to be when I get to that level? What is the chart going to feel like when I get to that level? So, oftentimes if everybody's watching, everybody was busy watching 4,200, right? I looked at the chart, I'm like, I don't see anything, because if you pull it back, 4,300 is much more resistance than 4,200.
Yes.
And, so to me, that break it. Who cares? I say break 4,300. Let's see what happens up there. That's just how I look at things. I'm not, as I always say, I'm not a level person.
Well, yeah, I mean, I agree. I think levels, they change. The market's always changing, and there's moving parts and things moving, and it's human emotion. The market is based on people. I mean, it's buying and selling, and, when everyone's looking at something, it does something else. And that's why it's the market, and we love it. It's exciting. It keeps us on our toes every day. It's always I'm always learning.
Yes, teaches you something new every day.
Absolutely.
Sometimes it teaches me what an idiot I am.
Oh, I'm told that all the time as well. It's like the market's like the ocean, and it's like this vast, and it will get you. If you think you can conquer that ocean, it will crash you down every time. So you gotta always stay humble with the market. But it's a beautiful thing. I want to talk about patterns, and pattern recognition is key. And understanding the patterns that we see, and they are changing. You mentioned that there was a pattern for a few weeks now that Tuesday was a red day, and then we had it was up by the end of the week. Yesterday, that pattern changed on us. What are you seeing with that?
So I am always alert to patterns, because I feel like the market teaches us a pattern, shows us a pattern over and over and over again. And as soon as everybody is aware of that pattern, it changes, as I say, it changes the rules. The market changes the rules. And so I had noticed a few weeks ago that every Tuesday had been red for 3 or 4 weeks. And then the week after Memorial Day, Tuesday wasn't red, but the second day of the week, Wednesday, was red. And then I went back and I looked, and every time that second day of the week was red, we rallied into the end of the week. And so I thought it was quite interesting that we didn't have a red day on Tuesday this week. So that changed that pattern. And so it'll be interesting to me to see if we rally strongly Thursday and Friday, because that would also change the pattern. And pattern changes are what create charts, right? Just look at that oscillator chart, churning below the line. And now this week, boom, up. So I look for changes in pattern. You'll often see me tweet something like the Dow hasn't had a 3-day winning streak in 2 months. Well, if that changes, something's changed in the market. Think of it like support and resistance. Okay. If people have come in to sell the Dow after 2 days, after a 2-day rally every single time, that's resistance. So if you change that pattern, you've gone through resistance and you've changed the pattern in the market. So something underlying has changed in people's psyche. They're no longer willing to sell the Dow every time it rallies.
Love that. That's exactly right.
That. So when you hear me say, things like the utilities, 2 days in a row, haven't done that in 2 months. What I'm looking for is what has support or resistance changed without looking at a level on the chart. Yes. I'm looking to see if the pattern has changed and therefore have people's mindset and how they're trading it changed.
I love that. Absolutely right. I mean, it's about volume, the price, and that movement, and looking at that pattern, because there are patterns to be seen. And it's right. As soon as people figure out that pattern, it changes.
That's right.
And that's exactly right. Love that. Supply and demand at the core. You told us you had some funny stories from the days at Goldman Sachs. And so I want to hear some funny stories.
Well, I don't know if they're funny, but so I tell this story that when I was going to interview there, remember, we didn't have the internet. Nobody had charts on their screens. I got a phone call from the head of admin, and who was the person who had asked if I wanted to come interview. And a couple of days before the interview, and he asked if I would put together a chart of General Motors and quote unquote, do whatever it is that you do.
Okay.
Can you imagine? Like they didn't even know what to ask. And so I took my hand-drawn chart of General Motors because I had nothing else. And I Xeroxed it and I drew in some lines, and I still remember the price. I said, well, if it can cross 43.5, I think it goes to 46.47. And I was going to fax it over. No, we'll send a runner. I mean, only people of a certain age will even know what that means. But, they sent a messenger over to pick it up. And a few days later, I get to the office thinking, A, I'm a woman. B, it's my first interview. I'm going to be meeting the low-level people. And so this admin guy says to me, okay, so I'm going to walk you across the trading floor and take you into Bob Mnuchin's office. And Bob Mnuchin was, I don't know, maybe the number 3 or 4 partner at Goldman and head of all of trading.
Wow.
Right, exactly. I know, I can tell you, I started sweating and I didn't know what I was going to say or do. And, and he parades me across the trading floor into his office, which is a glass fishbowl. And before I could even sit down, Mnuchin says to me, I'm long 100,000 shares of Motors. And I can't even imagine what my face looked like, but I'm sure I was shocked. And he says, aren't you the one who said if it goes to 42.5, it's going to 46 or 47? I don't even remember speaking, but I'm sure I shook my head yes. And he said, well, then have a seat, because if you're going to work at Goldman, you're going to put your money where your mouth is. Well, you have to understand, the Dow was trading maybe at, I don't remember where the S&P was, but maybe it was 300. But the Dow was trading at maybe like 2,500 back then. I mean, think about where it is today. It's 10 times, more than 10 times that. Stocks didn't move $1 in a day back then. Now it's so commonplace for stocks to move multiple dollars. But and there was actually a term of it. Oh, you'd say IBM is up a stick. And it was a big deal. Anyway, we also traded in eighths and quarters back then.
I remember that, the eights. Mhm.
General Motors closed up 2 3/4 on the day, which was for a $40 stock was a lot.
Yeah.
I don't even remember what the news was. I don't know anything. All I know is I saw that when I got home and I knew I had the job. And they made me an offer the next week. And on my first day of work, they sat me at the end of a trading desk and nobody came over to say hello to me. I was kind of near the men's room. All right, so maybe it wasn't so great. And at the end of the day, Bob Mnuchin came out of his office. And when Mnuchin came out of his office, everybody, who's Mnuchin going to talk to? And he wandered across the trading floor and he pulled up a chair and sat down next to me. And before he sat down next to me, the first thing he said was, that was one great trade we had in Motors. And I always laugh because the next day, people were like lined up to introduce themselves to me.
Wow.
And you know, Bob Mnuchin knew what he was doing.
Oh, yeah.
He's a smart man. And I just always think he knew by walking over to me, he gave me credence.
And
So.
You are a very smart woman as well. I am so impressed. Wow. That's amazing. And it's your work ethic and you learned and you're very good as well, besides the experience. And we so admire you. You're such a valuable part of the Twitter community and just the trading community. So wealth of information. I love that story. It's beautiful.
I say the market gods were shining on me that day.
Oh, you're so humble. You're amazing. Wow. I just love it. Do you trade options as well? And I want to ask you that. You do shares, options, and you look at put call ratios. And what are your thoughts on the 0 DTE nowadays and all the algo trading?
Okay, first of all, I don't trade options because, as I'm fond of saying, the only thing I know about options is every time I've traded them, I've lost money.
Okay, that's enough right there.
And that would probably go back to that you have to time. If you're trading options, you really have to time everything perfectly. I find because as time goes on, if what you're betting on doesn't happen, you get the decay. So
exactly that theta decay. Absolutely.
For someone who's, worrying about the stock popping 30 days out in time, I'm not good at that. So I do not trade options. I do care about the put call ratios though, because I care. It's a sentiment thing. And I care how bullish or bearish people are getting. A one-day reading here or there that's extreme, I will care about. Sometimes tangentially, depends where my other indicators are. But I will always care when I use various moving average lines. Sometimes I use a 10-day, sometimes I use 21, sometimes I use 30. Depends on which options ratio I'm looking at. But I care when it gets so low or so high.
Extremes.
That it's an extreme. So right now I'm watching the fact that the equity put call ratio has been in the 50s for weeks now. I don't have anything extreme. If I get an options ratio with a 4 handle, I'll call that extreme, especially considering I've had readings in the 50s for so long. And I'm watching the 10-day moving average line, which is getting pretty low, not extreme yet. On 0 DT, God. Where can I go on this? Last fall in November and December, the put call ratios, especially the equity put call ratio, had gotten so extreme. I mean, the readings were so the same way we're in the 50s all the time now. We were like over 1 and in the 90s, which is very rare. I mean, the equity put call ratio generally will trade between 50 and 80 or 50 and 90. So, when you start getting day after day after day after day of these extremes, it's important to me. It shows a change in sentiment, a change in pattern. And yet it didn't matter because the market kept sliding in December. And, even though all the moving average lines were off the charts, and everybody, all the option specialists kept telling me, well, it's those 0 days to, blah, 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 blah. Finally, I capitulated. And I said, all right, I guess perhaps the indicator is useless now. And I capitulated just as it mattered. So it turns out my summation of it is it probably increases the extremity of the readings and makes everything more extreme, I guess, is really, it exacerbates everything. But has it made it lose its effectiveness in using it as a sentiment indicator? I don't think so. But I think it's exacerbated everything. It's just, it's made everything 10 times more hyper, I guess.
Great.
And that's how I would look at it.
And what do you think of this algo trading and that whole rise? I mean, obviously vastly different from from the 80s and 90s and even 2000s, early, what are your thoughts on all that? And they say how they follow the Fibonacci levels and, there's set levels that they buy and sell at. How does that affect the markets you're trading, if any?
I feel like there's always some kind of black box fad. There was a black box fad heading into the 87 crash. There's in options, remember gamma. When was the last time I heard anybody talking about gamma? No, that's gone now too. Algos, everybody, the algos and the CTAs and it is what it is. And I don't know. Meanwhile, my indicators, I feel like they still work. And
yes.
They're simple. And like I said, I don't get it right all the time. I get it wrong. I mean, I wish I didn't, but I do. But I play the odds. And my indicators to me give me the odds. And sometimes it gets spoiled and sometimes I'm wrong. And that happens. But the algos probably just exacerbate everything too.
Exactly. Classic. I love this. This is so true. Is exactly the point, is that it goes back to the core and the simple principles and what works, and you follow what works, and that's the core of the market. And even though it's changed and evolved over the years, it's still the same.
You know why? Because we are humans and human nature doesn't change.
Exactly.
That's why. We will always get emotional about money.
Yeah, it's human
nature.
Who
we are.
It's made up of people, and the emotions never change. And that is why you can compare bear market cycles to each other, and there's many similarities with the ups and downs. It's because it's based on human emotion and how irrational humans can get, and the exuberance in many time periods, and then the despair in the other time periods. And that's what makes cycles, and economic cycles and market cycles, and we live in cycles.
Hey, what is it? It's a recession if your neighbor loses his job. It's a depression if you lose your job. So.
Love that. I heard that. Who said that?
I don't know, but I've been hearing it for
a lot.
Years.
I heard someone else say that. And then I saw that Tom Lee, I think, said something about, he said some version of that. And, Drunken Miller, I like listening to him and watching him. And, he talks about the cycles, and he talks about the sideways market. And he says, but you could still make money in these markets. And, I think there's a lot of wisdom in all that. And knowing that, just play the market, follow price. And there's nothing that I love your tweet, your pinned tweet is nothing like price to change sentiment.
Yeah.
And that's the key to everything. So Helene, how was it like trading in Asia? Now, you were in Asia for quite a bit, Singapore, beautiful country over there. Tell us about that.
Well, we went because of my husband's job. So we were there for 9 years. We were 5 years in Singapore and 4 years in Shanghai. And again, the internet was dial-up when I went. It was 1996. And commissions hadn't come down that much. I mean, they'd come down from the 80s, but they weren't obviously where they are now. So I was just buying and selling stocks on my own, and that was it, keeping up with my work. And I wasn't doing very much. And I certainly wasn't watching every tick. Because I wasn't sitting in front of a screen all day long. And that was the biggest change for me, was to go from, a job where you're on a trading desk and you're sitting and you watch every single tick and you see every news headline as it comes across and you react.
Mm-hmm.
I was sleeping. That's just, I was a 12 or 13-hour time difference, and I was sleeping most of the time that the markets were open. And I think it changed for me how I look at the market, because I stopped caring about every little tick. And I was able to pull back and look at the market a little bit more big picture-y, and not worry that, not every day went my way if I really had a view. And it was easier because I was sleeping while it was happening. So to me, I don't know. I feel like it helped me. I wonder if, nowadays with Twitter and the internet being so much faster, I would have the same experience, but I don't know. In the 90s, that was the experience I had.
Wow. I love that. That it almost like disciplined you to not be so fixated on every tick and every movement, and look at the bigger picture to establish patterns. That's nice. I love that. How many years were you out there?
We were there 9 years. So we were 5 years in Singapore and 4 years in Shanghai.
Wow, so you must have learned Mandarin.
I did, although don't ask me to speak it now because it's been 20 years and
awesome. What a world of experience.
And my Mandarin wasn't so great then, so.
Ni hao. I just know ni hao.
Pretty much.
Amazing. Now I want to talk about tennis. You and I both share a love for tennis, and I've been watching it and playing it. Tell us, are you a player as well as a watcher? And who are some of your favorites?
So I don't play anymore. I did play for a long time. And then I developed tennis elbow, so I stopped playing. And I'd love to get back to it to see if the tennis elbow develops, but my sister wants me to take up pickleball, because my sister has given up tennis in favor of pickleball. She'd like me to play. But I do love watching it, and I'm a huge fan. And currently, well, I'll tell you a little story. We saw back in 2004, when we were living in Asia, we'd gone to Australia and we went to the Australian Open. And we saw this young teenager play on an outside court, and he took a guy who was then top 10 in the world to 5 sets. He ended up losing, but it was Rafael Nadal. And I became a fan instantly.
I love him.
Instantly, and have been a fan ever since. Just because he was so exciting to watch.
How about this thing? This thing?
You're right. He was wearing the pedal pushers. I get capris. Now they call them capris.
Yeah.
And anyway, so like when you get to see a player who's so young and so exciting to watch, to me, that's just fun. So I do go to the US Open every year, and we do like to wander the outside courts to see the young kids or the up and comers. And I think it was 2021. I was with my sister and we wandered out to one of these small, maybe court 5 or court 6 on the outside, and we saw Alcaraz play.
Yes.
And I cannot even remember who he was playing, but the stadium was sort of empty, and it had rained that morning, so I guess attendance was low anyway. And we were just like, oh my God, look at him, he's so good. And at the end of it, I turned to my sister and I said, I'll bet we don't see him on an outside court again. And sure enough, here we are. So
love that.
He'll be, now that Rafa's sort of retired, I guess he'll be my new favorite.
Wow. So what do you think he does tomorrow?
I hope he wins. I hope he wins.
It's exciting. I know when you watch them up close, you feel I as we talked before that we started recording, I also go to US Open with our family, and we go to the outside courts, and you feel that connection with them. You see them right up close. They're right there, and they even come towards you, and you hear them cursing, and right? And they curse in their own languages. There was an Italian guy we saw last year. I forgot his name. Then we saw a Serbian a couple years ago who was really awesome. I forgot his name as well. But then we went to Louis Armstrong like you, and we saw Wawrinka. And it's amazing when you go that week, that initial week, you get to see them. And then, hey, some of them go on to win. And I saw women's last year, the Swiatek, and I saw her at Louis Armstrong. And I know she's playing right now at the French Open. I think she just beat Haddad. Is that right? Or she's playing to Haddad.
They're playing today. I don't know if they played yet. Okay,
they don't play yet. They're going to be playing today. I saw that out there, but I think I don't know. I like her a lot. So to me, I like to watch her and see how she does. Hopefully she wins.
I like her too. The other thing, if you notice when you get to see them up close, is how big these women are. They don't look so big on television.
They're very big.
You see them in person, you're like, God, she's huge.
They're big. I know.
And not just tall. I mean, they're muscular.
Very muscular. They are. And then I also love Nadal. And then what about Federer?
I like Federer. But it's sort of like bull and bear. You got to pick a side. And I became a Rafa fan. But yeah, Federer is a beautiful player. Well, he was.
Yes, the flow, beautiful flow. Let's go back to the 80s, and let's talk about Martina and Everett, Graf, in the 90s. What do you think about all of those? Who did you like back then?
Oh, God. I would say I was a little bit of a Steffi Graf fan. But I was definitely more of a Martina fan.
Yeah, she was hardcore.
I loved the serve and volley. I just loved it. And she was just so different. She was so fit.
Yeah.
So yeah, on the girls' side, that's who I like. And in the 90s, I liked Lindsay Davenport. Always liked her, even before she started winning.
Very nice. And then for men, I know you and I discussed Agassi. I did like Agassi myself. What are your thoughts there?
I always liked him, even when he was a wild child.
Yeah, very likable.
He was very likable in a weird kind of way. Yeah. I was never really a McEnroe fan. I go with Agassi. And my husband will say, you never liked Sampras.
Oh gosh, never Bridget. I remember seeing her come to his game, and years ago I was in Florida. Wow. Yeah, I didn't care. Sorry.
Yeah.
Sampras.
I know.
Either. I liked Agassi, and then going back, what was that big game with McEnroe? And they made a movie out of it. What was that? Was there a big game or something? I don't know.
No, I don't know. I know about the Billie Jean King.
Or Billie Jean King.
Oh, yeah. The Battle of the Sexes.
Oh, okay. Yeah.
Which I was quite young. So, I sort of kind of remember it. But I did read Billie Jean King's autobiography. I think she had a ghostwriter with her. Excellent book. I
Mm.
would highly recommend it because it is partly a history of her and her life, but it's a history of women in America.
Oh, that's
And
nice.
it's I mean, she was a big part of the whole women's rights movement, and it's fascinating.
That is. I'll have to check that out. Billie Jean King. Oh yeah, it was Borg and McEnroe. That was like the
Oh,
big
yeah.
rivalry. I
Yeah.
remember that.
Yeah.
Remember always
I was never a fan of either one of them, honestly. So
yeah.
hard to
That
get
was-
excited.
Yeah, exactly. So tell us about your cooking. Are you do you enjoy cooking for yourself and your husband or for others? And what type of food do you like to cook?
Well, yes to all, and I'll cook anything. I like cooking. I love baking. I
Mm.
love baking. So I like, we have these friends who they'll invite us over for dinner, and I'll say, okay, I'll bring dessert.
Mm.
And she's at the point where she'll say, of course you will.
What
It's
are
like
some
trying
of,
new recipes and seeing,
Ooh.
what's new and different.
What type of baking? Do you like muffins? Do you like cakes or cupcake? Like what type of baking?
Honestly, anything. I do cookies, I'll do candy, I'll do cakes,
Oh,
I'll do, different kinds of frozen desserts. I'm not, I'll go anywhere.
I love that.
I just like to, and I like to try different techniques and see what works. And
Wow, you're very creative. That's for sure. You're a creator. You're creating beautiful foods and you're trying new things. You're always learning and always learning in the markets as well. And well, you're such a cool person. I have to say, Helene, this has been such a true pleasure spending this time with you, learning from you and hearing all about you. And I love this tennis, cooking, Asia, trading, markets. I mean, Goldman Sachs, you're a pioneer and you're an amazing woman.
well, thanks. Don't get too excited.
I'm very excited about you, and we really admire you, and thank you so much for all you contribute to the financial community. And thank you so much for talking with us today.
Thanks for having me.
Absolutely. Thank you. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on The Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.